Did you know that every time you use your phone, drive your car, or even turn on a light switch, you're interacting with a metal on the brink of a historic supply shock? This isn't gold. It's not lithium. It's silver. For every 1 ounce of silver mined from the earth, humans are now consuming 1.25 ounces. This isn't a temporary blip. It's a structural deficit that's been widening for 3 consecutive years. The world is eating into its silver stockpiles at an alarming rate. And while most investors are distracted by the glitter of gold or the hype of tech stocks, they're missing a quiet revolution happening in plain sight. A revolution that could send the price of silver to levels most would consider impossible. The question isn't if silver will revalue, but how it will happen, and what that means for a global economy already walking a tightrope. So, why is this unassuming metal, often called poor man's gold, suddenly at the center of a geopolitical and technological perfect storm? For centuries, silver's primary role was monetary. It was money. From Roman denarii to Spanish pieces of 8, silver was the backbone of global trade. But then, governments decided to sever that link. In 1965, the US removed silver from its coinage. The world moved to fiat currency, money backed by nothing but government decree. Silver was demonetized and relegated to a mere industrial commodity. Its price plummeted, and it faded from the public's financial consciousness. This is the deep value principle at play. An asset, once universally recognized as money, becomes forgotten and drastically undervalued. But here's the twist. While the world forgot about silver as money, technology did not forget about silver as a miracle element. It has the highest electrical and thermal conductivity of any metal, it's highly reflective, and it possesses antimicrobial properties. This makes it utterly indispensable. Your smartphone, your laptop, solar panels, electric vehicles, none of them work without it. For decades, the market treated silver like just another industrial input. But the game is changing. The demand side of the equation is about to go into overdrive, and the supply side simply can't keep up. This matters to your wallet because when an essential commodity with no substitutes enters a prolonged deficit, its price doesn't just rise, it reprices. We're not talking about a 10% gain, we're talking about a fundamental reset. Let's look at the numbers for 2024. The Silver Institute projects a global demand of 1.2 billion ounces against a mine supply of only about 840 million ounces. Recycling helps, but it still leaves us with a staggering deficit of over 200 million ounces for the 4th year in a row. Now, let's add the elephant in the room, artificial intelligence. Every AI server, every data center being built to power this new technological age is packed with silver. Goldman Sachs estimates that AI-driven demand alone could add another 100 to 200 million ounces of demand annually by 2027. This isn't some far-off projection. It's happening now. The IMF and World Bank are forecasting a global economic rebound, which means more industrial activity and even more silver demand. But here's the critical part. Supply is inelastic. You can't just flip a switch and produce more silver. The average time to bring a new silver mine from discovery to production is 15 years. And most silver isn't even mined directly. Over 70% of it is a byproduct of mining for other metals like copper, lead, and zinc. So silver production is hostage to the economics of other commodities. If a copper mine isn't profitable, the silver in that ore stays in the ground, no matter how high the silver price goes. This is the why behind the what. The market has priced silver as if supply can easily meet demand, but the data shows this is a mathematical impossibility. We are consuming our savings account of physical silver, and when the vaults in London and New York are finally empty, the real price discovery will begin. This brings us to the core conflict. On one side, you have the Western financial system, which has a vested interest in keeping silver prices suppressed. For decades, large commercial banks have used paper derivatives, futures contracts on exchanges like the COMEX, to manage and control the price. For every 1 ounce of real physical silver available for delivery, there are hundreds of paper claims trading against it. It's a system built on confidence. As long as everyone doesn't ask for their physical metal at once, the game continues. On the other side, a multipolar world is emerging. Nations like China, India, and Russia are increasingly viewing physical commodities, not US dollars, as real wealth. They are the world's largest consumers of industrial silver and have been quietly accumulating physical metal for years. They're not just buying it for solar panels and electronics. They see it as a strategic asset, a hedge against the devaluation of Western fiat currencies. This is the showdown. The paper price set in New York versus the physical price being driven by industrial necessity and sovereign demand in the East. What happens when a major manufacturer, say a solar panel giant, can't source the physical silver it needs? They won't care about the paper price on a screen. They will pay whatever it takes to get the metal and keep their factories running. That's when the paper market breaks. That's the turning point. So what does the next 12 to 24 months look like? Three scenarios emerge. Scenario 1 is the slow grind. The price gradually rises to the $40 to $50 range as the market slowly wakes up to the deficit. The paper markets manage to contain the volatility, but the underlying physical tightness becomes undeniable. It's a slow-motion train wreck. Scenario 2 is the supply shock. A major industrial player or a sovereign nation decides to bypass the paper markets and secure a massive physical offtake directly from miners. This act breaks the COMEX, causing a price disconnect. The paper price becomes irrelevant, and the physical price rockets to $75 or even higher, almost overnight. It would be a nickel moment for the silver market, similar to what happened at the London Metal Exchange in 2022. Scenario 3 is the monetary reset. A broader financial crisis, perhaps triggered by sovereign debt defaults, forces a reevaluation of all assets. In this chaos, both gold and silver are remonetized, not necessarily by governments, but by the people themselves as a safe haven. Silver doesn't just go to $75. It begins a journey back to its historic ratio with gold, implying a price in the hundreds. We are at a historic crossroads. For 50 years, the price of silver has been dictated by paper contracts and financial engineering, but physics is about to have its revenge. A structural deficit, fueled by green energy and now supercharged by AI, is colliding with a rigid, unresponsive supply. It's a mathematical certainty that something has to give. The question we opened with wasn't just about a price target. It was about what happens when an asset everyone needs, but no one thinks about, suddenly becomes the most important commodity on the planet. The repricing of silver won't just be a number on a screen. It will be a signal that the global economic system is undergoing a fundamental shift from paper promises to physical reality. If you want to understand how these forces are playing out in real time, we've compiled a resource guide breaking down how to track physical inventory levels at the major exchanges. The link is in the description. So, I leave you with this question. In a world moving towards peak demand for a finite resource, what is the true value of the one metal you can't print? Let me know your thoughts in the comments below.